For Morningstar, I'm Christian Charret. Vanguard is one of the largest asset managers in the world, with more than $5 trillion US in assets under management. In the United States, they're known for offering both mutual funds and ETFs at rock-bottom prices. But since entering the Canadian market in 2011, their offerings here have exclusively been on the ETF side. This changed on June 25th with the launch of 4 mutual funds, and I'm here with Tim Huver, Head of Product at Vanguard Investments Canada. Tim, thanks for joining us.
Thanks for having us.
So before we talk about the funds themselves, I think the most important aspect of the story here is the fact that the fees on these new funds are significantly lower than what many Canadians may be used to. Can you explain what the strategy is here?
At Vanguard, it's never been a question about ETFs or mutual funds or active versus passive, because we do both. We do mutual funds and ETFs, and we have a large active franchise in addition to passive franchise. It's really been about low costs at the end of the day. And so if you look at what we've launched here in Canada with the introduction of 4 actively managed funds at costs, first year costs that will range between 34 and 40 basis points, that is significantly lower than what we see, less than half of what you see in the industry on average today. And so it really comes from our mutual ownership structure of our parent company, the Vanguard Group, and really ensuring that investors have the best chance of investment success.
So Vanguard made its reputation worldwide as a provider of low-cost index funds, but these are actively managed funds. Is this part of a new switch in strategy at Vanguard?
Well, it's interesting to know we are known for our indexing expertise, but if you look at Vanguard's assets, the $5 trillion in assets under management that we have, about a quarter of those assets are actively managed funds. And so really it's never been, as I mentioned, active versus passive. We offer both. We are one of the largest active managers in the world. We led with ETFs here in Canada when we launched in 2011. And over that time, we've grown to the 3rd largest provider of ETFs in the market. And so we've been really pleased with how investors have adopted and embraced our low-cost approach. And so when you look at the ETF industry, $160 billion in assets under management, primarily passive today. When you compare that to the active mutual fund industry, that is $1.5 trillion in assets under management, and that's some of the highest fees in the developed world. We saw an opportunity to bring our low-cost philosophy and products to a larger group of investors, Canadian investors, and really give them the best chance of investment success on the active side as well.
So can we expect more mutual fund launches in the near future then?
Very much closer to the starting line than the finish. As I mentioned, we do have quite a bit of active expertise. If you look at the first 4 funds that we've launched here, these are mandates that are well recognized, some of our flagship products, some of our best partners in terms of sub-advisors that we're using. And so we've replicated those proven strategies that we have around the world and have brought them to Canada in the form of Canadian domiciled funds. So we see this as very much the start in the beginning, and would expect to continue to launch within this space.
Speaking of the new funds, can you tell us a little bit about the specific strategies that you've brought to Canada?
Sure. So 4 products that we've started with. We have the U.S. Value Fund. It's the Windsor U.S. Value. We have a Windsor fund in the U.S. that dates back to 1958, and so long track record in history there. International Growth, a Global Balanced Fund, and a Global Dividend Fund. And so not only with low fees, but also I think a unique fee structure that we're introducing into the Canadian market as well. I mentioned those first year fees will range between 34 and 40 basis points, but then we'll move upward or downward based on the performance of the underlying sub-advisor. And so as investors see returns of hundreds and hundreds of basis points on the positive side, that will move towards 50 basis points, capped at 50 basis points, so still very, very low cost. And if for whatever reason we see underperformance from a sub-advisor, the fees will also move in the other direction below that initial fee that we're charging within the first 12 months. So that really is the base fee, and we'll move there. And so we think that really aligns the best interests of investors with our sub-advisors.
And I suppose leveraging existing relationships with existing sub-advisors is one way to keep costs down. Another one is that is interesting is the fact that these funds are for now are only offered in Series F or institutional shares, which don't have any embedded compensation. Is this part of the Vanguard strategy then?
Well, so if you look at Vanguard globally, we do not pay for distribution. We do not provide any trailers on our funds. And so really the target initially will be that fee-based advisor. And we're seeing an organic growth with all this talk about transparency around fees and low costs. We are seeing organic growth in that fee-based advisor segment, more what were maybe commission-based advisors gravitating towards a fee-based model and realizing the benefits of that. So primarily targeted at fee-based advisors. We will also have institutional share classes as well.
And you're also distributed right now on two discount brokerage platforms, Questrade and Qtrade, which are right now the only ones that take F-class fees. Given the changing regulatory environment where we just saw proposals to ban embedded commission for discount brokerage, is there any plan to expand the distribution on the discount brokerage channel?
Vanguard hasn't historically paid for distribution, whether that's trailers or platform fees. We do hope that the new regulation does free us up to be on more platforms and reach more investors in the future. But you know, we feel that that payment part can create a conflict of interest. So that is something that we have steered away from in the past.
Tim, thank you very much for sharing all this with us today.
Thank you, Christian.
For Morningstar, I'm Christian Charret. Thank you for watching.